Or not. Think of it like an invisible enemy, quietly working against your money every single day. And that enemy? It's inflation. You know that $100 bill in your wallet? It feels safe, right? But here's the thing, its actual power, what it can buy, is constantly shrinking. That same $100 is going to get you less and less as time goes on. So saving, well, that protects the money you have today. But investing, that's how you protect its value for tomorrow. So, that really raises the big question, doesn't it? If just letting your money sit in cash means you're actually falling behind, what are you supposed to do? what are your real options for putting that money to work?
All right, to answer that, we have to get super clear on the three main paths your money can take. And I mean crystal clear, because understanding the difference here is absolutely critical. Honestly, mixing them up is a total recipe for disaster.
So check this out. This table really breaks down the DNA of each strategy. Think of saving as your short-term safety net, like your emergency fund. Totally safe, but not for growth. Then you've got trading. That's a high-risk, short-term gamble on price swings. But investing is the long game. The whole point isn't to get rich quick. It's about building real wealth slowly and steadily over decades by managing risk, not just taking it. And this right here, this is the number one trap that so many beginners fall into. They mix these things up. The second those circles overlap, you're in the danger zone. You might be saving your money in a super risky stock, or trading with your retirement nest egg, or maybe you expect your long-term investments to give you that same adrenaline rush as day trading. Keeping these things in their own lanes, that is the absolute key to avoiding huge mistakes. At the end of the day, it really just boils down to two completely different mindsets. The trading mindset, that's all about speed, predictions, trying to outsmart the market. The investing mindset, though, is about having a process and having patience. It's the difference between buying a lottery ticket and hoping for the best versus actually building a house, brick by steady brick. Okay, so if we've decided we're on the path of the builder, the long-term investor, then what's the actual engine that creates the wealth? Well, it's this incredible mathematical force that, honestly, feels like magic when you give it enough time to work. And this quote right here, it just nails it. It gets right to the heart of the matter. See, your most valuable asset isn't some secret stock tip. It's time. Just time. Why? Because a small amount of money you invest early on can grow to be way, way bigger than a huge amount you invest much later. Time is literally the fuel for this wealth engine.
And this is what that engine looks like when it's running. Simple growth, it's just a straight line. Predictable. But compounding, that creates this incredible exponential curve. It's that magic point where your returns start earning their own returns. Now, it's going to feel painfully slow at first, I'm not going to lie. But you give it a few decades, and that curve just takes off. It becomes this unstoppable force.
But listen, this engine doesn't just run on its own. You have to think of it like a machine with three essential parts. You need all of them. First, you need time. We're talking decades here. Second, you need consistency. That means sticking to your plan, not chasing the next shiny object. And third, you have to stay invested, riding out the ups and the downs. You take away any one of those pieces, and the whole engine just sputters out. All right, so now we get how the engine works. That's the easy part. Now we have to talk about the road you'll be driving on. Because look, knowing how a car works is one thing, but actually driving it through storms and over bumpy, rough terrain, that's a whole different challenge. And, well, this is what that road looks like. It is not a smooth, straight highway. The market goes up, the market goes down. These swings, this volatility, it's a normal feature. It's not a sign that something's broken. I know seeing your account balance drop can be really scary, but you have to understand it's just an expected, normal part of the journey. This whole situation creates something called the expectation gap, and it's so important to understand this. On the left, you see what people expect, this smooth, perfect upward curve. But on the right, that's reality. It's messy, it's volatile, but it's still trending up. Almost every single catastrophic investing mistake, panicking, selling everything at the absolute worst time, is born right in that gap between expectation and reality. Fixing your expectations from the start is your best defense. And then, especially in the early years, you're going to face a totally different challenge. It's what I call the boredom gap. This is the ultimate testing ground. You're doing everything right, you're being disciplined, you're investing consistently, but the progress just feels tiny. It feels like all your effort isn't paying off. And this moment right here is where almost everyone quits, usually right before that compounding curve is about to go vertical. So, let's say you do it. You navigate the scary volatility, you push through the boredom. What does actually winning this game look like? What are the real practical pillars of success? Okay, first things first, we got to do a mental detox. Let's just blow up all the myths that stop people from even starting. You think investing is only for the rich? No! Small, consistent amounts are what build fortunes. You think you need to be some kind of expert? Nope. Simple, boring strategies almost always win. And the biggest one? Thinking you've missed your chance. You haven't. Look, The best time to start was yesterday. The second best time is right now. Real success, then, it rests on these 5 pillars. And you'll notice it's all about your behavior, not your brain power. It's about managing your own emotions, not being a genius. It's about avoiding the big, dumb mistakes, not trying to be perfect. It's just having a plan, letting time do the hard work for you, and always thinking in decades, not months or days.
Look, if there is only one thing you remember from this entire explainer, please let it be this. This is the whole game, boiled down to one simple idea. It is not about being smart. It's not a battle of wits against Wall Street. It's just a battle of patience, consistency, and discipline with yourself.
And really, that brings us to the final question for you. See, investing isn't about trying to find the next hot stock or getting rich overnight. It's about choosing a path. It totally reframes the challenge. It's not a game of intelligence, it's a test of your character. So the only real question left is, are you ready to choose the path of the patient, long-term builder? Have you ever just stopped and wondered why some people get wealthy and others, well, they just don't, even when they're making a ton of money? The secret? It isn't some crazy stock tip or a lucky break. It's actually much simpler. Building wealth is exactly like building a house. You can't start with the penthouse. You need a blueprint, you need a solid foundation. So today, let's unroll that blueprint and see what it really takes to build lasting financial freedom.
Right off the bat, so much of the financial world wants you to believe that the path to wealth starts right here, in this chaotic, tangled mess of trying to pick the next hot stock. But let's be real, that's a total myth. The reality is, investing is like step 5, not step 1. Trying to invest without a stable financial base is like building a skyscraper on quicksand. It is absolutely destined to collapse.
Okay, look at this. Because this slide completely flips our idea of what success looks like. You've got Profile A, earns a massive $150,000 a year. But after everything's said and done, they only keep $5,000. Now compare that to Profile B. They earn less than half that, but somehow manage to keep $30,000. So who's actually getting rich faster? It's proof right there that wealth isn't what you earn, it's what you keep. So the solution isn't just to earn more, it's to work smarter by following a very specific blueprint. It's called the Financial Order of Operations. It's a sequence, a step-by-step process that turns financial chaos into a stable, wealth-generating structure. This right here, this is the architect's plan we're going to walk through together, layer by layer.
Okay, let's grab our hard hats and get to work. First things first, we've got to pour the concrete, we've got to establish the bedrock, we are laying the foundation.
The entire structure, everything we're going to build, rests on these 2 bottom layers. First up, income stability, just knowing that you have predictable money coming in the door. And then, right on top of that, expense control. These 2 layers, they have to work together to create the single most important building material in your entire financial life.
But let's be honest, controlling your expenses today is harder than it has ever been. We're all fighting against what you could call the invisible drain. Digital payments make it so easy to spend without feeling it. Subscriptions bleed our accounts dry, drip by drip. And of course, the second our income goes up, so does our spending. This isn't a failure of willpower, it's a failure of system design.
So this brings us to a crucial point. The whole goal of your foundation is to create and maximize your investable surplus. This number, that little gap between your income and your expenses, that is the true engine of wealth. It is the only money you have to build the rest of this pyramid. A small surplus means you're building slow. A large surplus means you're on the fast track.
So, how do you guarantee you have a surplus? Well, you don't just hope for it, you engineer it. This diagram shows the perfect flow. Your paycheck comes in, and money is automatically sent to savings and investing before you ever get a chance to spend it. You literally pay yourself first. I'm telling you, this one system is more powerful than a lifetime of feeling guilty about your budget.
And you get to choose an operating system that actually fits your personality. If you're someone who loves details, you might go with a zero-based system where every single dollar gets a specific job. But hey, if you prefer more flexibility, you could try the 50-30-20 rule, which just splits your income into big buckets for needs, wants, and savings. Honestly, the best system is the one you can actually stick with.
Okay, the foundation is set, it's stable. But a foundation all by itself is vulnerable, right? Now we have to protect our construction site from the inevitable financial storms. It's time to build your defenses.
Your defenses are these two critical middle layers, the emergency fund and debt control. Think of them as the walls, the roof, even the security system for your financial house. They are what keep a tiny leak from becoming a catastrophic flood that washes everything away. I know, an emergency fund can feel pretty overwhelming, so let's just break it down into a simple construction plan. Step 1, get a quick $1,000 buffer for small shocks. Then, build that up to cover 3 months of your absolute must-pay bills. And finally, you fortify it to 6 months or more. Its real purpose isn't just about the money, it's to stop you from making panicked, terrible decisions, like selling your investments at the worst possible time when a crisis hits.
Next up is debt control. And you have to understand that not all debt is created equal. This spectrum is so important. Over on the left, you have toxic, high-interest debt like credit cards and payday loans. This is a 5-alarm fire. You have to put this out before you even think about serious investing. Then in the middle, you've got your neutral debt. And way over on the right, you have productive debt, which can actually help you build wealth. You've got to know the difference.
So how do you attack that toxic debt? You've got two proven methods. The avalanche method is the most efficient, mathematically. You go after the debt with the highest interest rate first, and you'll save the most money. Then there's the snowball method, which is all about psychology. You attack the smallest debt first to get a quick win and build momentum. So, which one's better? Well, the math says avalanche. Psychology says snowball. The right one is just the one you'll actually stick with until the job is done.
All right, the foundation is solid. The defenses are up. The whole structure is secure. And only now, after all that crucial work, are we finally ready to build the penthouse. It's time to talk about investing.
And here it is, the peak of the pyramid. This is the fun part, the part that actually multiplies your wealth. But notice how it's the smallest part of the whole structure, and it's held up by everything else we just built. This is where your investable surplus goes to work for you, compounding over time, but only because it has a stable base to stand on. So, as you invest, how do you even know if you're winning? Forget your salary. The master formula, the real scoreboard of your financial life, is your net worth, what you own minus what you owe. This number measures ownership, not just your earnings. You should calculate it every few months and just watch it grow.
Okay, a fundamental rule of investing. You have to align your strategy with your timeline. Money you need for a house down payment in 2 years, that's zone 1. It absolutely cannot be exposed to the crazy swings of the market. It belongs in a safe account. But money for retirement in 30 years, that's zone 3. That money can and should be invested more aggressively to capture growth. Mismatching these is a rookie mistake with seriously painful consequences, like having your down payment cut in half right before you need it.
You know, following this blueprint does more than just organize your money. It fundamentally changes who you are. So this final section is all about your new identity, becoming a wealth architect. This right here is the ultimate identity pivot. You shift from the chaotic mind of the spender, who's driven by hype and social media and stress, to the ordered, logical mind of the owner. The owner focuses on tracking, on learning, and on designing their environment for success. They build systems instead of just relying on motivation that comes and goes. Before signing off on any project, every good architect does a final inspection. So here's your master checklist. Just go down the list. Is your emergency fund built? Check. Is your plan to get rid of toxic debt active? Check. Is your cash flow positive? If you can check off these items, you have completed the architecture.
And that is the moment we've been working towards. When you've followed the blueprint and you've done the work, you're not gambling anymore. You are investing from a position of incredible strength, safety, and control. Architecture complete. You are now cleared for market investing.
So now the blueprint is yours. Every step, every layer, every tool is right here for you. The only question left is, well, it's the most important one. Are you ready to pick up the tools and start building?
All right, welcome. Today, we are going to pull back the curtain on the mechanics of the financial markets. The goal here is simple: to shift your entire mindset from being a reactive price watcher, someone who's just glued to the ticker all day, to becoming a thoughtful business owner who actually understands the engine that's driving all those numbers. Let's dive right in. So, let's start with the big one.
It's a question I think we've all asked ourselves, right? Especially when things get a little crazy out there. You see the flashing red and green, you hear the dramatic headlines, and it's really easy to feel like you're just placing a bet and rolling the dice. So, is that all it is? Is the stock market just one giant casino?
Well, the short answer is a hard no. The idea of the market as a casino, it's a powerful myth for sure, but it's just not the reality. The reality is that the stock market is a powerful economic engine. Think of it more like a highly regulated, super efficient meeting place, specifically designed to move money from people who have it, the savers, to the businesses that need it to grow, to innovate, and to create value. So, our very first step is to learn how to look beyond that distracting, blinking ticker tape. We're going to uncover what the market's real job is. And honestly, the best way I've found to picture this is with a really simple metaphor: the bridge of capital. This is the place where the savers and the builders of our economy finally meet. Here's how it works: it's pretty straightforward. On the left bank, you've got savers. That's people with extra capital who are looking to grow their wealth over time. And on the right bank, you've got businesses, companies that need that capital to fund new ideas, build new factories, and create jobs. The market, it's simply the bridge that connects the two, allowing capital to flow from one side to the other. And this right here, this is the crucial takeaway. When you invest, you're not just making some random bet. You are becoming a partial owner of a real business. And with that comes a share in both the future rewards and, of course, the inherent risks. Thinking like an owner, not like a gambler, is probably the biggest mental shift you can make. Okay, so that's the big picture, the why of it all. But what actually happens when you hit that buy button on your phone? Let's go inside the machine and see how your order actually finds its match. So it all works in a three-layer stack. At the very top, there's you, the investor. But you can't just stroll onto the floor of the New York Stock Exchange. You need an intermediary, and that's the broker in the middle. They provide the access and the technology to connect you to the bottom layer, the exchange itself. That's the marketplace where all the buyers and sellers are matched up. And, this process isn't free. There are small friction costs, like fees, and that's just part of what keeps the whole machine running. Now, let's zoom in on that exchange layer, because this is where the magic happens. It might look super complex, but really, it's just a very sophisticated auction. On one side, you have bids from all the people who want to buy, and on the other, you have asks from all the people who want to sell. The exchange's job is to constantly, and I mean constantly, match these bids and asks. And that continuous matching process is what we call price discovery. It's how the current price of a stock is set, second by second. Now, this is a really critical distinction to understand. Where does the money actually go? In what we call the primary market, like an IPO, investors are giving their money directly to the company. This is pure capital creation. The money is used to build the business. But most of the trading you hear about every day, that happens in the secondary market. And here, investors are just trading ownership stakes among themselves. The company doesn't see a dime of this money. This is ownership transfer, and its main purpose is to provide liquidity so you can buy and sell shares easily. So, now we know how a trade happens, but the billion-dollar question is, why do prices move so much? To get that, we need to explore what I like to call the physics of price, these hidden forces that are always pushing and pulling on the market. Listen, if you only remember one thing about why prices move, make it this. There is only one rule, one reason, a simple imbalance between the number of buyers and the number of sellers. That's it. Full stop. Every news story, every earnings report, every bit of gossip, it all just feeds into this one simple equation. It either makes more people want to buy or more people want to sell. So, what causes that imbalance? Well, there are really three main forces that are always pushing on that scale. First, you have the fundamentals. How is the business actually doing? Is it making money? This is what drives long term value. Second, you've got macro factors, the big picture stuff like interest rates and the health of the overall economy. And third, and this is the big one for short term moves, is pure human psychology, things like fear, greed, and what everyone thinks is going to happen next. And this idea of expectations, oh man, this is a real game changer. You see, the market doesn't actually react to the news itself. It reacts to the gap between the news and what everyone expected the news to be. It's the surprise that matters. That's why a company can report record profits and the stock still drops. Why? Because the market, for whatever reason, expected even more. Understanding this expectation gap is the absolute key to decoding those confusing daily price swings. And all of that psychology, all those expectations, they create a kind of predictable rhythm over time. You can see it right here, this emotional wave that cycles up and down all around the steady upward sloping line of actual business growth. It goes from optimism to euphoria, then tips over into anxiety, fear, and even panic, before starting all over again. The key isn't to predict it perfectly, but just to know that this emotional cycle exists. It helps you anticipate the waves instead of getting swept away by them. So, this all brings us to the final piece of the puzzle. It brings us to the ultimate question, the one that truly, finally, helps you adopt the mindset of a business owner. So, in the short term, the market looks like this. It's just noise. It's chaotic. It seems completely unpredictable. This is the world of emotion, of psychology, of those daily supply and demand imbalances we talked about. If you live here, you're a price watcher, and honestly, you're probably going to have a really stressful time. But watch what happens when you zoom out. When you extend your time horizon, the picture changes completely. The long-term view smooths out all that chaotic noise and reveals the real signal, a rational, upward curve driven by the fundamental growth of great businesses. This is the business owner's perspective. Your time horizon, it changes absolutely everything. So here it is. This is the ultimate mindset shift. You have to stop asking, why did the price move today? That question is a trap. It's the path to madness. Instead, you need to learn to ask the owner's question. Does this piece of news, this event, this whatever, does it fundamentally change the long-term value of the business that I own a piece of? Once you start doing that, you'll see that volatility is just noise, not a real threat. And your patience becomes your greatest superpower. Just think about it. What would change for you if that was the only question you ever asked?
Okay, let's get right into it. We've all been there, right? You're scrolling online, typing in that one question. What's the best investment right now? Should you be in tech stocks? Or maybe crypto? What about real estate? It's this endless, frustrating search that usually just leads to chasing whatever's hot. But what if that's the wrong question altogether? Today, we're going to look at a much smarter way to think about building wealth. It's not about finding one single magic bullet, but about building a powerful, resilient financial ecosystem.
You know, the problem with looking for that one best asset is perfectly shown right here. It's like thinking a car can run on just a single gear. It just doesn't work. And why is that? Well, because no single asset, not one, wins in every economic season. So if you bet everything on one thing, you're creating a massive single point of failure. And when that hot stock or asset class inevitably hits a rough patch, well, your entire portfolio goes down with it.
So, this is where we need to make a huge mindset shift. The goal isn't to find that one magical perfect gear. The real goal, the true solution, is to build a powerful engine, an entire ecosystem of different assets that are designed to work together. Each one has a specific job to do, to both push you forward and protect you from the inevitable bumps in the road.
To really make this idea click, let's use a fun metaphor. I want you to imagine your portfolio is a high-performance supercar. It's not just a random collection of parts thrown together. No way. It's a finely tuned machine built on 4 critical pillars that all work in harmony.
And here are those 4 pillars in action. Think of them like this. You've got the engine, which is all about growth, the shock absorbers for a smooth and stable ride, you've got the airbags for crisis protection, and yeah, you even have an optional nitrous oxide button for those high-risk, high-reward moments. So let's pop the hood and break each one down.
First up, the most important part of our vehicle, the engine. This is what generates all the raw power. It's the system responsible for driving your wealth forward year after year for the long haul.
The main component
in our engine is stocks. It's pretty simple. When you own a stock, you own a tiny piece of a real business, and you have a claim on its future profits. They make you money in a couple of ways, through the business growing and its stock price going up, and sometimes through dividends. They really shine when the economy is expanding. But what's the trade-off? Well, they're volatile. And that means you have to handle the emotional stress of watching the market bounce around.
So how do you actually buy stocks? For most of us, it's not about picking individual companies. We use pooled funds, and there are two main flavors you need to know. First, you've got mutual funds. These are great if you want to set it and forget it, automated, hands-off investing, but they often come with higher fees. Then you have ETFs, or exchange-traded funds. These are amazing. They trade just like a stock all day long, so you get real-time pricing and they're usually way more cost-efficient. They are fantastic building blocks for a modern portfolio.
Now, another key part of your growth engine can be real estate. The best thing about it, it's tangible. You can literally see it, touch it, stand on your investment. It generates returns two ways, through rental income, which gives you cash flow, and through the property's value going up over time. The main downside, the big risk here, is that it's not liquid. You can't just click a button and sell a house in 5 seconds like you can with a stock.
Okay, on to our second pillar. Look, a powerful engine is awesome, but a supercar with a huge engine and no suspension, that would be a bone-shaking, terrible ride. And that's exactly where the shock absorbers come in to give you that crucial stability.
The primary shock absorbers in your portfolio are bonds. And here's what's so fascinating. With a bond, you completely flip your role. You're not an owner anymore, you become the lender. You're loaning your money to a government or a big company, and in return, they promise to pay you back with fixed interest payments. Bonds tend to do really well during economic slowdowns when everyone's running for safety. Their main enemy, though, inflation. That can eat away at the value of those fixed payments over time.
And here you can see that beautiful counterweight in action. When the economy is growing, stocks are usually the star of the show, driving your returns. But during a slowdown, stocks often take a hit, and that's when investors flock to the safety of bonds. Their prices can actually go up, offsetting some of those losses from stocks. They are a natural, perfect balance to each other.
Right. On to pillar number 3. Sometimes you don't just hit a little bump in the road. Sometimes you hit a brick wall. And for those moments, you need airbags. These are assets designed specifically to protect you during a real crisis. The classic financial airbags are precious metals, like gold and silver. I mean, they've been seen as a store of value for literally thousands of years. They tend to perform best during really specific times, periods of scary inflation, currency debasement. That's when money itself is losing its value, or major geopolitical shocks. But, and this is so important to remember, precious metals don't produce anything. They don't pay you an income, they don't give you a yield, they are pure, simple insurance. Another protection asset is commodities. We're talking about the raw materials that power our entire economy, like oil, wheat, copper, you name it. These act as a very direct hedge against inflation. I mean, just think about it. When the price of all this raw stuff goes up, the price of everything you buy goes up too. They provide a really strong defense against inflation. But man, they come with some extremely high volatility. All right, let's get to our fourth and final pillar. And I have to be crystal clear here. This one is 100% optional. This is the nitrous oxide button on your supercar, a speculative sleeve for those high-risk, high-reward bursts of speed. This is the world where you find assets like cryptocurrencies and other alternatives, things like private equity or even collecting fine art. The potential returns, they can be astronomical, but the risk and the volatility are just as massive. The number one rule for this part of your portfolio is non-negotiable. You only put in capital that you can truly afford to lose. This is not a required part of building wealth. It is a high-stakes bet. So, we've covered all four pillars: the engine, the shock absorbers, the airbags, and the optional nitrous. Now, let's put it all together and see how this amazing system actually works in the real world. What you're looking at here is the immutable, unbreakable law of investing. Risk and reward are forever tied together. You cannot get higher potential returns without taking on higher risk or volatility. It's impossible. Down on the bottom left, you see the low-risk, low-return assets, like bonds. And as you move up and to the right, you find stocks, and way out at the far end, you find things like crypto. Every asset has its place on this spectrum.
And here it is, the master matrix. This is your ultimate cheat sheet. This table ties everything we've talked about together, lining up each asset with its structural job inside our supercar metaphor. Stocks are your growth engine. Bonds are your stability shock absorbers. Gold is your protection airbag, and crypto is that speculative nitrous. Each one has a specific, important job to do.
This all brings us to the most important takeaway of this entire explainer. It's not really about memorizing all these assets. It's about a fundamental shift in the one question you ask yourself as an investor.
This is the question we have to stop asking. It is a complete trap. It encourages you to think short-term, to chase performance, and to try to time the market, all strategies that consistently fail for almost everyone. It keeps you focused on finding that one single magic gear.
Instead, I want you to start asking this. This question is the one that unlocks long-term success. It shifts your focus from speculating to engineering. It forces you to think like an architect, designing a resilient system where all the different parts work together to perform in all of the economy's different seasons, the good and the bad. Because in the end, that's what true wealth building is all about. It's not about picking the winner of today's race. It is about building a vehicle that can endure the entire journey, no matter what the terrain looks like. Master the ecosystem. Build a portfolio. All right, let's get right into it. This isn't just another guide to the stock market. Think of this as a playbook, one designed to completely flip your mindset from being a spectator to being an intelligent owner. We're about to pull back the curtain and show you the simple, powerful engine of wealth creation that's hiding just beneath all the noise. You know, the very first thing we have to get our heads around is the illusion you see right here. Every single day, we're hit with that jagged, chaotic red line. That's the market's daily opinion. It's loud, it's emotional, and honestly, it's mostly a distraction. But underneath all of that is the smooth green line. That's the real story. That's the actual steady growth of a business's value. The entire game is learning to ignore the red line and focus on the green one. And that leads us perfectly into our first big idea, figuring out the difference between all that price noise and the real value underneath. This isn't just some clever tactic. It's the fundamental skill you have to build if you really want to see what's going on.
And this quote just nails it, doesn't it? Being an owner isn't about trying to guess which way that jagged line is going to jump tomorrow. It's about understanding the business you own so well that all that daily chatter just becomes, well, irrelevant. You're focused on the performance of the business, not the mood swings of the price.
Okay, so if we're all about the business, let's get down to basics. When you buy a stock, what are you actually buying? Let's dissect the anatomy of a single share to see what you truly own.
First step, you get power. Voting rights mean you actually get a voice. I know it sounds small, but even with just one share, you get a fractional seat at the big table. You get to help influence who's in charge and the long-term direction of the company you partly own. Second, and this is a big one, you get a claim on the profits. When the business you own does well and makes money, you are legally entitled to your slice of that pie. This is the direct financial reward for being an owner. It's why we're here. And third, you get a claim on the actual stuff, the assets. Think of this as your safety net. It means you own a tiny piece of everything. The buildings, the patents, the cash in the bank. It's a real, tangible stake in the whole operation. So when you put it all together, you see this. These three powerful rights, your influence, your share of the earnings, and your claim on the assets, they're all bundled up into that one little thing we call a share. See? It's not a lottery ticket, it's a deed of ownership. All right, so we've taken apart a single share. Now let's zoom out, way out. To be an intelligent owner, you've got to understand the whole landscape, the full map of where the opportunities and, yes, the risks are hiding.
I love thinking about it this way. The market is like a mountain range. Down in the foothills, you've got your massive, stable, large-cap companies. They're safer, more predictable. But as you start to climb higher, up into the mid-caps and the small caps, well, the air gets thinner and the terrain gets a lot rougher. The potential for a huge summit is there, but so is the risk of a misstep.
And all across this landscape, you'll find two main tribes. You've got your growth innovators. These are the sprinters. They're pouring every single dollar they make back into the business to get bigger, faster. Then you have the established value companies. They're the steady giants, more focused on just generating a ton of cash and handing it back to their owners.
And here's where that philosophy hits your wallet. Growth stocks are priced for what they might become. You're paying a premium for all that future potential. Value stocks, on the other hand, are often priced for what they're worth right now, and sometimes you can even get them at a discount. The smartest owners, they know that the strongest portfolios often find a way to blend both.
Which, of course, brings us to the real question. We can see the map, we know the different kinds of terrain, but how in the world do you actually navigate it? How do you pick your path?
This is where we get to the good stuff. Building your portfolio. It's time to go from just knowing this stuff to actually doing it, using specific frameworks that separate being a real owner from just, gambling.
Look, an intelligent owner doesn't guess. They have a system, a filter. Before any company gets a single dollar of your money, it has to pass these 4 non-negotiable questions. First, do I actually understand this business? Second, is it financially healthy or is it a mess? Third, are there real clear reasons it's going to grow? And finally, is the price I'm being asked to pay fair?
And this is what that process actually looks like in practice. You pour thousands of potential companies into the top of this funnel, and your 4 questions do the hard work, weeding out the hype, the junk, and the gambles, until only a handful of well-understood, high-conviction businesses trickle out the bottom.
And once you have those carefully chosen companies, you build with them intelligently. A great portfolio has a core. These are your big, stable companies that act like a gravitational center. And then, orbiting around that core, you have your satellites. These are the smaller, faster-growing bets that give you that exciting upside potential. The core keeps you grounded, the satellites give you lift. Okay, so you can have the perfect framework, the perfect portfolio. Everything can be set up just right. But there is one final threat. And here's the plot twist. That threat isn't a market crash or a recession or some competitor. No, it's a lot closer to home. Just look at this beautiful equation. It's so simple. Your returns from the stock price going up and the dividends you get paid are supercharged by compounding. But then the whole thing gets multiplied by time. And look at that. Time is the biggest multiplier on the board. Holding on for the long haul is the mathematical rocket fuel for building wealth. But there is one thing, one single variable that can shatter this entire formula. It can turn a winning strategy into a losing one, just like that. The final threat is you. It's us. It's our own psychology. It's that urge to chase the hype when everyone's excited. It's that instinct to panic and sell when things look scary. It's getting cocky after a few good calls. These are the things that make us break that beautiful equation. They're what make us interrupt the incredible power of time. And this quote just says it all, really. The market isn't a game of who's smartest. It's a game of who's got the right temperament. Day after day, it systematically transfers money from people who can't control their impulses to those who can. Your discipline is a bigger asset than your IQ. So, let's wrap this all up. What did we learn? 1. Focus on the real business value, not the daily price noise. 2. Remember that a share is a true piece of ownership. 3. Use discipline frameworks to choose your companies and build your portfolio. And 4, maybe the biggest one of all, mastery of the market really begins with mastery of your own mind. So we'll leave you with this thought. Once you have this playbook, the whole game changes. The question is no longer, what's the market going to do next? The real question, the only one that matters, is what are you going to do?
All right, let's talk about mastering mutual funds and ETFs. And we're going to do it by using a powerful idea, the architect's blueprint for modern investing. Let's jump right in.
You know, for a lot of us, building wealth can feel like you're staring at this incredibly complicated puzzle with a million little pieces. It's overwhelming, right? But what if I told you it's not a puzzle at all? What if it's much more like following a simple, elegant blueprint?
Now, to really understand why thinking like an architect is such a game changer, we first have to understand the problem most people face. And that brings us to our first section, the investor's dilemma.
So here's the big question that messes with so many people's heads when they're starting out. Is the only way to get ahead to frantically search for the next big thing, the next winning stock? I mean, is that really the only game in town?
Well, this image lays out the tough reality of trying to do it all by yourself. When you go it alone, you're up against three huge challenges. First, the incredible amount of time it takes to do proper research. Second, the emotional discipline needed to not panic during market swings. And third, the massive risk of putting all your eggs in just a few baskets. It's a tough, stressful path.
So, if going it alone is the problem, what's the architectural solution? That leads us right into section 2, the pooling solution.
And here it is, the other side of the coin. Instead of that chaotic, stressful path of the individual investor, you can simply pool your money with others into something called the fund. This one move solves all three of our big problems. Instantly, you get diversification, you get professional management, and you get simplicity. It's a totally different approach.
So let's be super clear. What exactly is a fund? Well, it's pretty simple. It's just a big pool of money collected from lots of different investors that's managed with a single, clear strategy. And it holds a whole basket of different investments. Really, it's just strength in numbers.
Okay, let's look under the hood for a second. This is a really key point. When you invest in a fund, you don't actually own the individual stocks or bonds inside it. No. Instead, you own units or shares of the fund. It's the fund itself that owns all the underlying assets. That little separation is what makes the whole system so powerful and efficient.
So, how much does one of those units cost? That's where something called the net asset value, or NAV, comes in. Just think of it as the official price tag for one share of a mutual fund. It's calculated just once, right at the end of every trading day. It's a simple formula. You take everything the fund owns, subtract what it owes, and divide by the number of shares out there. Simple.
All right, now we get to a really big decision in our blueprint. Section 3, active versus passive. I'm telling you, the choice you make here is one of the most critical architectural decisions for your entire portfolio.
And this image shows the great divide perfectly. On one side, you have active funds. Their goal? To beat the market. They have a manager who's picking stocks, trying to find winners. On the other side, you have passive funds. Their goal is much simpler. Just match the market's performance by tracking an index. Now, here's the reality. Active funds cost way more, and study after study shows that over the long haul, the vast majority of them actually fail to beat the simple, boring index they're trying so hard to outperform. I can almost hear some of you thinking, passive investing? Isn't that just boring? And yeah, I get it. But this quote really hits the nail on the head. History shows us time and again that it's the boring, repeatable processes that create absolutely spectacular growth over the long term. It's about getting the job done, not about the daily excitement. So these funds come in two main packages, ETFs and mutual funds. The biggest difference is how they trade. ETFs trade all day long, just like a stock. Mutual funds, on the other hand, only get priced once a day. Now, while ETFs often have super low costs, mutual funds are fantastic for making automated, recurring investments, what some people call a systematic investment plan, super easy. But no matter which wrapper you choose, there is one invisible force you have to guard against. And that force is fees. They are the silent killer of your returns. Seriously, think of fees like gravity. They're invisible, but they are always, constantly pulling down on your portfolio's growth. And that wedge you see on the screen, that's what we call the lost wealth gap.
So how big is that gap? Just how much damage can a small fee do? The number is shocking. A seemingly tiny 1% fee might not sound like a big deal,
But over 30 years, that 1% can eat up nearly 28% of your total potential returns. 28%. That's a huge structural flaw in your blueprint that is so easy to avoid.
Okay, that's enough of the theory. Let's roll up our sleeves and get practical. It's time to move from the what to the how in Section 4, your modern blueprint.
Every good structure starts with a solid foundation, right? This pyramid shows you how. The base, the biggest part, should be built with your safest assets, like bond funds. The middle is for your core growth. Think broad, diversified stock funds. And then, only at the very top, with a tiny portion of your portfolio, should you ever consider speculating on riskier things. You always build from the bottom up. And here's a simple 5-step framework to put this into practice. Step 1, define your goal. What are you investing for? 2, choose your asset class, stocks, bonds, etc. 3, choose your philosophy. We'd suggest a passive core is the way to go. 4, check the key metrics, like the expense ratio, that fee we talked about, and for an index fund, something called tracking error. And finally, step 5, keep it simple. A few great funds are so much better than a messy, complicated portfolio.
So what does a finished blueprint actually look like in practice? Well, a simple and incredibly effective portfolio can be built on just 3 pillars. First, a core broad market index fund for your growth engine. Second, an international fund to give you global diversification. And third, a bond fund to act as a stabilizer, a shock absorber when things get bumpy. That's it. It's stable, diversified, and powerful. And that brings us to our final and maybe our most important section of all. Section 5, staying the course. Because listen, a brilliant blueprint is completely useless if you don't have the discipline to follow it.
These right here, these are the common pitfalls, the cracks in the foundation that can bring the whole structure down. Things like chasing after whatever did great last year, ignoring those fees that silently eat away at your money, making things way too complicated with dozens of funds, or worst of all, reacting emotionally to scary headlines and switching your strategy. You have to avoid these at all costs.
So what's the annual maintenance for your financial structure? It's called rebalancing. It's simple. About once a year, you just adjust your portfolio back to its original plan. This automatically forces you to sell some of what did really well, selling high, and buy more of what's been lagging, buying low. It is discipline built right into the system.
We started out looking at a complex, frustrating puzzle, but now you have the blueprint. The principles are simple, the tools are right there for you, and the plan is clear. So the only question left is the one right here. On the screen, are you ready to be the architect of your own financial future?
You know, every great machine has an engine that gives it balance and control. And when it comes to your wealth, well, that's exactly what fixed income or bonds are designed to be. So let's pop the hood and take a look at the blueprint for your financial stability engine. Every investor is basically on a seesaw. On one end, you've got this incredible desire to grow your money, and that's where stocks come in. They're the engine of growth. But on the other end, you have this deep need to protect what you've built. And that's the job of the anchor, bonds. They're built to cut down on volatility and be that steady hand in a really turbulent market. So this brings us to the fundamental challenge, right? It's the one every single investor faces. How do you find the right balance? How do you get the growth you need without taking on just terrifying levels of risk? Well, the key to solving this whole dilemma, it really lies in understanding how bonds work. Before we get into the nitty-gritty, let's get a crystal clear definition. At its very heart, a bond is just a loan. That's it. You are the lender, and a government or a big corporation is the borrower. They promise to pay you regular interest for a set amount of time, and then at the very end, you get your original loan back. That's the core of it. Pretty simple, right? Okay, so this blueprint here breaks down the actual contract. You, the investor, you provide the capital. In return, the issuer gives you a certificate that lays out a few key terms. The face value, that's just the initial loan amount. The coupon rate is the fixed interest they promise to pay. The coupon payment is the actual cash that hits your account. And the maturity date, well, that's the big day when you get all of your original money back. All right, so now that we get the basic contract, let's really look under the hood of our stability engine. We're going to deconstruct all the different parts and forces that make this thing work to protect and stabilize your portfolio. Of course, not all bonds are created equal. Think of them as different parts for your engine. You've got government bonds, which are super safe, but the trade-off is a lower payout or yield. Then there are corporate bonds from companies. They offer higher yields, but you guessed it, more risk. You've also got municipal bonds, which often come with some nice tax advantages. And then there's TIPS, which are specifically designed to shield you from inflation. Okay, this is where things get really dynamic. See, a bond isn't static. Its value can and does change after it's issued. There are three key forces at play here: interest rates, credit risk, and time. So let's break down how these levers really affect your stability engine. Now, if there is one thing you need to understand about bond pricing, this is it. It works exactly like a seesaw. When new market interest rates go down, the value of your older, higher paying bond goes up because it's more attractive. But on the flip side, when new rates rise, your older, lower paying bond